Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at PayPal Holdings, these guys just had their Q4 earnings call last evening, and while the results for Q4 were fine, even good, 2024 guidance was kind of bad, which is why pre-market the stock is down about 9%. And really the stock has been a poor performer in the last year, in the last 5 years, down 31%, clearly was up a lot during the pandemic and is now back down as growth starts to return to normality, really return to nothing based on what 2024 guidance is. They do have a new CEO. Alex Chris was just on CNBC a couple of weeks ago talking about their Innovation Day. Oh, in the future, they're going to shock the world with what they do. And the Innovation Day wasn't all that amazing, but it was kind of what they should be doing. It's making checkout better, making it more efficient, introducing Fastlane for both their branded and non-branded product to really make checking out less cumbersome, making sure that it's fast. That's why it's called Fastlane. Introducing things like smart receipts, making the PayPal app itself better. Right now, they have a PayPal app that's kind of behind what other apps are offering. Putting all of the offerings that they have within PayPal together, whether it's buy now, pay later, some of the rewards cards, rewards programs, etc., their savings accounts, and all of those things that PayPal actually makes more money on, actually putting them in front of the user and cross-selling a lot of that stuff is going to be important into the future. So the question is going to be, how is this stuff going to float into their earnings? And the answer right now is undetermined based on what the results are for 2024, at least initially. Q4 earnings themselves, like I said, actually pretty good. Market expected 7.9 billion. They hit 8 billion. Non-GAAP EPS of 1.48 was above the expectations of 1.36 per share. The problem is guidance kind of sucked. Q1 guidance for 2024 on the revenue side is about 6.5 to 7%, depending on currency adjustments. And then your actual bottom line guidance is $5.10 on a non-GAAP basis, basically flat year over year from 23, and 360 on a GAAP basis. Kind of flat if you adjust for the positive impact of the sale of Happy Returns. So I mentioned GAAP because they specifically pointed this out in their earnings release. In the future, they are going to adjust their non-GAAP results to include stock-based compensation, so that $5.10 for some reason does not include stock-based compensation. That's how they've always reported it historically. It's basically overstated in relation to what's going to be in the future. So they kind of outline it here. The guidance for 24 does not include stock-based compensation. Beginning with Q1, they are going to include stock-based compensation. So as you think about that, the $5.10, if you're thinking about P ratios, really remember that does not include stock-based compensation. Once you included, and that's $1.4 billion, that's a lot of money, it's going to bring it closer to that GAAP EPS and make it kind of in the $4 range. So assume non-GAAP EPS adjusted for stock-based compensation of about $4 rather, down from the $5.10 that they're presenting here. It doesn't really change any way you look at it, but it's just a more realistic way of showing it. But again, if you think of a P ratio at a $5.10 EPS and a $55 stock price or whatever it's going to be when the market opens, it's not really 10x or whatever. It's probably closer to 14x based on the $4 non-GAAP EPS that they're going to start reporting in Q1. So growth here is okay. Active accounts are down 2%, but that's expected because they talked about last call on how they're going to stop investing money into accounts that are kind of not being used or just not profitable. That number is probably going to start dropping quarter over quarter, but monthly active accounts, the actual people that are using the accounts, is up 1%, which is good to see. It's kind of interesting that about 200 million accounts are just not being used on a monthly basis. Kind of their business model, but kind of weird. On a transaction per account, per active account basis, up 7% if you exclude their unbranded stuff, about 14% when you include their branded stuff. And that's important, the branded, unbranded layout. One of the things they talked about is how they have to kind of get back to growing the branded checkout part of the business because they make more margins on that. If you're not familiar with branded, it's basically when you go out and you check out through PayPal. Unbranded would be their Braintree product, is when you go out to a website, you check out through something. You don't really know what you're checking out through. It kind of looks like it's their own system. Maybe you're checking out through Uber or something like that, and it looks like you're just checking out within the app. Somebody's running the behind the scenes stuff of that, and it's a company like Braintree. That's kind of what their unbranded, their white label product is. And that product has grown at a much faster clip than the branded checkout and become a bigger and bigger part of the business. And that's good from a TPV basis, but it is a much lower margin business. And that becoming a bigger part of the business means that the overall margin profile of the business drops, which is why they're not really growing as much as they have, despite still growing at a decent clip on the top end. And that top end growth is slowing as well because of this as well, because the top line and bottom line results are impacted by the fact that more and more of their business is unbranded. So a couple of things they talked about, really that app changing the way they look at branded checkout, making branded checkout more attractive. On the Braintree side of things, they talked about how now that they've rolled out Fastlane, they feel like they have a best in breed business on the unbranded card processing side. And they feel like they can probably go into some of these contract negotiations, contract renewals, and kind of ask for more money, maybe improve margins on Braintree's side, because that is becoming more than a third of their business, and they really have to drive growth in that area as well, but also improve margins in that area, because that is always going to eclipse the branded checkout part of the business. And also, they talked about moving that part of the business into the small business space where margins are higher, into the international space where margins are higher. So it'll be interesting to see how that works out. It'll be interesting to see if they can actually get back to growing branded again, because that is key in making this investment proposition work, because that is a higher margin business. On top of that, if people are using the branded PayPal business side, they can cross-sell them some of their other stuff, rewards, cards, buy now, pay later stuff, all things that they can make more money on. And then you've got Venmo as well, a big part of their business that I think is maybe missing some beats on what they could do. I think Cash App is catching up to them a little bit, maybe offering a more complete offering in terms of, yeah, you can buy stocks on Cash App. Why can't you do that on Venmo yet? I think you can maybe buy crypto, but I don't think you can buy stocks at the moment, but correct me if I'm wrong. But again, peer-to-peer stuff is very well represented in PayPal's fintech platform, as Venmo is one of the more popular ones. But other ones are emerging as well, and people always have their phones as well, and they could just use Apple Wallet and the credit card that's tied to it rather easily. That's one of the concerns with a company like PayPal. As phones proliferate the world, is PayPal going to lose the ability to kind of make sure that their branded checkout is first and in the forefront of people's minds? Because whenever I go shopping outside, I use my phone. Whenever I shop online these days, if Apple Pay is available, I use it. I rarely actually use PayPal, even though I do have an account. I still use it on a website or two because it's kind of there and easy to use. It's already, if I'm already logged in, it's not a huge issue. But if you're not logged in, if you have to create an account and Apple Pay is available for you, why would you ever use PayPal? That's kind of the thing that they have to break through in the future. And as we talk about branded checkout, unbranded checkout, etc., what's important here is how does that impact overall transaction margins? And the nice thing about transaction margins is that they actually returned to growth in Q4 of 2023. And the expectations are for 24, based on what they talked about on the call, is that that's going to be steady, but not growing in 2024. And that's a bit disappointing as well, because really as a business, the reason their bottom line growth has sharply fell off in the last couple of years is obviously the growth has started to fall off, but a lot of their growth has come from the unbranded side of the business, and that cuts into your bottom line margins, your transaction margins, and that's kind of a problem. But it's also good to see that it's not dropping anymore. Yes, year over year growth has dropped 4%, but sequentially on a quarter-over-quarter basis, it has actually kind of bottomed out in a way, and that's sort of a good thing. If they can kind of start to see that tick up even a little bit, that is going to be a good thing for investors and their bottom line. So a couple of takeaways here. Most of them not great, and really the focus is on 2024 guidance. Like, what is going on here? Why are they not growing at all? They talked about this being a transition year. They talked about all the investments they're making in their product, and that obviously hits the bottom line. But they did also just have layoffs. Is that not flowing into the bottom line? Maybe some of those costs are not going to be realized until later into 2024 and maybe into 2025. Some of the things that they released right now, they talked about those not flowing into the assumptions for 2024 until they see the actual results. So maybe there's a bit of conservatism built into here. But at the end of the day, growth is the engine that keeps the stock price growing, and they're just not showing it right now. And this is kind of the first opportunity for this new CEO CEO to make their pitch, and the pitch isn't really being heard by the stock market because the growth isn't there. You're basically going from growing at a decent clip in 23 to not growing at all in 24. And again, this is still a company that's going to generate $5 billion in free cash flow. That's why I like it personally. That's why I own these shares. But again, I bought them when they were at $56, $57. So kind of in the spot they're at now. So I'm not too upset about the stock price now. But if you bought this stock at $100, at $150, you're like, what the hell is going on here? Why is this stopping? Why is this not growing anymore? What's going to happen in the future? And that's unclear. What they need to do is they need to focus on branded checkout, growing that again, because that is a higher margin business. They need to focus on improving margins in Braintree. It remains to be seen whether they can do that. They need to improve on kind of making their product better, making Venmo more attractive, making PayPal more attractive, because those are their margin drivers. It's not really Braintree, but Braintree itself is the one that's growing, and that's not the one that puts the PayPal branding at the forefront, which is a problem. But at the end of the day, this is a company that's still going to generate a ton of free cash flow for the next couple of years. They're going to use that free cash flow to buy back shares, and you may be thinking, well, it's good that the stock price is depressed because they can buy back shares at a lower price, and that's good for me. Yes, that's true, but a CEO will never actually purposefully do that. So they must really believe in this guidance. And maybe they're being a bit conservative, but they're probably not being hugely conservative because that's kind of the reality. I think the CEO would want to show something really attractive here, and they're not really doing that at the moment. So that's a bit disappointing. Does this change my look at the stock itself? Maybe a little bit from a valuation perspective. It probably lowers it a bit because I think the expectations, and my expectations too, were closer to $6 billion in free cash flow for 2024. And there's just no growth in that front in the near future. And I'm not sure what this means on a go-forward basis. I think what's going to be more important than this call is the guidance they give for Q1 2024 on the Q1 2024 call, rather, because that's going to be more reflective of some of the things that they did during their innovation day. It's going to show whether this margin improvement for the quarter on a sequential basis is holding steady or continuing to improve. And if those things happen to be true, if those changes that they made on the innovation day are kind of yielding results, they're saying, hey, maybe guidance is actually going to be better than what we showed on this Q4 call. That could be a boost that the stock needs, because right now I think the stock is going to be kind of depressed for a while. And that's difficult to see when you look at something like PayPal and it just basically hanging out in that $50 to $60 range for the last couple of months as the rest of the stock market soars and soars and soars. As a shareholder of PayPal, you're probably thinking, oh, this sucks. I should have just bought NVDA. And that's, I own NVIDIA as well. And in a way, I'm like, well, this kind of does suck. But it doesn't mean that PayPal is a company that's doomed. It's just a company that might have a thesis that it's going to take longer to play out than some would have liked, because based on this guidance, this thesis is going to probably be a 1 year plus play, and the stock price might not do much until then. So as I look at the valuation and disclaimer, video is purely for informational, educational, entertainment purposes only. It is not an investment advice. Please do your own due diligence. So again, balance sheet looks good. The price I have in here is the pre-open price as of the 7th, really. So if the stock price opens closer to $57, like it's trading at pre-market, keep that in mind. Looking at basically actuals for 2023, it's shown an estimate here, but not reflected in the data just yet. 2024, kind of looking at the guidance they gave, basically looking at the bottom end of their guidance, at least $5 billion in free cash flow, and maybe even a bit optimistic on the revenue side given their Q1 revenue guidance, but at the end of the day, it is what it is. And then sort of slowing growth into the future, margins improving a little bit into the future, but not quite. They talked about how they're going to use a ton of their money for buybacks. They specified 70 to 80% on their call. You might have seen that, but I'm using 50% given the fact that the buybacks are there, but they are also issuing about $1 to $1.5 billion in stock-based compensation every given year. That's going to offset some of those buybacks. So about half of their overall money is going towards buybacks and offsetting that stock-based compensation. So about $13 billion in the next 4 to 5 years, which is a good thing. That's going to improve the buyback yield. Right now, the market is pricing this stock, if I go to about $57, at about a 6.7% free cash flow yield, about 8% on a go-forward basis. As I look at what this should be, it's kind of hard to decide. That's what you'll have to play around with for yourself. You can hit this file, make a copy button if you want to play around with these valuation metrics. But I'm kind of in that, like, mostly in that 6% to 7% free cash flow yield space is kind of what you should value a company like this that's relatively consistent, that's growing, even if it's a relatively slow clip on a go forward basis. And that could change if growth starts to trail off. But right now, I'm still expecting some sort of growth, some sort of margin improvement into the future. So about a free cash flow yield of about 6.3%. And I think that's relatively aggressive on that free cash flow yield, given what the market is pricing it at today. But that kind of gives you a 10% expected return based on the $63 price point, about a 12% expected return on a $57 price point. So decent return from here. But obviously, if you look at it from the perspective of a lower free cash flow yield, if you think this should be getting an 8% free cash flow yield, but the market is giving it this morning based on the next 12 months of free cash flow estimates, it's a 5.5%, 5.8% return. So maybe this is a bit too aggressive on that front. But the way I look at it is I would look at this company, given the trials they're facing in the future, given the lack of growth, as a company that I'd need a target return of about 15% from here. And that kind of gives me a margin of safety, because generally you expect a target return of about 10% from the market. So if I'm looking at a 15% target return from PayPal, there's a margin of safety built into there. And based on these assumptions, based on these buybacks, based on this free cash flow yield, I get a fair value of about $50, 50.8. And that seems reasonable to me. Like, I don't love PayPal as a company right now based on the guidance they're giving into 2024. I do own these shares. In the past, I kind of was buying these shares in that $55 to $57 range, and they're trading there right now. But given the change in guidance, given the change in dynamics, I think I have to lower that buy point. I'm not at a spot where I want to sell these shares. I want to give them at least another quarter to kind of see what's happening with the company, see if margins are improving, see if they're going to actually guide for more growth after their Q1 earnings call in 2024. But right now, if I was going to grow my position, I'd have to get a pretty attractive valuation. And when I talk about attractive valuation, that's probably in the low 50s. Sometimes I look at these companies, these kind of mature businesses that are generating a ton of free cash flow. What would a really good deal be? And a lot of times, it's kind of like what happened with Meta a couple of years ago. It's like, if it's trading at a 10% free cash flow yield and it's a good kind of mature company, and I think Meta is a better company than PayPal, so maybe I need something better. That'd be interesting. That'd be like a roll of the die that's worth taking, because hey, they're going to generate a ton of free cash flow. I'm getting 10% of that based on that market cap of $50 billion. But at a $50 billion market cap, that's almost 25% lower than it's trading at today, or a price of $46.50. So if this stock keeps falling and it starts getting into that range, that $46 to $51 range, would I potentially pick up more shares? Yes. But right now, I'm just okay holding what I have. I'm not really all that interested in buying more shares. The free cash flow yield certainly is attractive. They're going to buy back a ton of shares. But PayPal is also one of those companies that, when I look at the future 5 to 10 to 15 years from now, do I see PayPal as a key part of the economy, as a key part of what people are using on a day-to-day basis? Not really. And a lot of that is because these things are around. It's so much easier to use Apple Wallet, Google Wallet, whatever, Google Pay, whatever it's called. Zelle is out there, Cash App is out there. A lot of these things are competing with what PayPal is doing. And yes, their Braintree product seems very good, but it's not a high margin product. And if their free cash flow starts actually falling, that's going to be a problem, because all of these things right now are still assuming that they're going to continue growing and improving margins into the future. And if that changes, if growth drops off, if growth doesn't resume after 2024, then this stock could just not be a good returner on a go-forward basis. Free cash flow yields are only as good as the growth that a stock drives. And if the growth falls off, even if your free cash flow yield stays the same and your free cash flow yield is lower, you're not getting a return on this stock. So this is going to be a two-part thesis. One, that free cash flow rather, keeps growing. And two, that eventually, as they return to growth, the actual yield that the market is giving this company improves. Because if it doesn't, if it stays at that 8% range that it's at today, and the growth here is as I show it, your returns are going to be, low single digits, which isn't very interesting. So if you feel that way, even at today's prices, even at the $57, that number is still kind of low to mid single digits. It's just not that intriguing. If you feel that way, it's not that intriguing. If you feel like they can return to growth and improve margins, then it gets kind of interesting. Even now, at a $57 price point, it's a 12% return based on those assumptions. And I think those are relatively reasonable, even slightly aggressive assumptions based on what PayPal has shown. So I'm not running out the door to buy these shares right now, but I can also see how you would look at this and say, this is an interesting valuation, because it's what I said when I looked at this maybe 6 to 8 months ago when I initially bought this stock. But the thesis at the time was that at least some growth was going to continue. And realistically, that thesis, at least right now, is in a way broken, because there's no growth projected in 2024. And I'm not sure that there's going to be growth projected into 2025 on that basis. So that is a bit of a problem. And that means that in a market where everything is flying, this could be dead money for a bit of time. And I'm okay with that. I just need to see more before I make a decision as to whether or not I want to hold this for the long term. Because if the Q1 earnings call is more of the same, I may just say, this isn't the company for me. But if the Q1 earnings call is good and they guide higher based on the things they did on their innovation day, this or a price around this could be a really good time to get into the stock. But for me, I'm just not quite there yet. But if it keeps dropping, if it gets into the low 50s, high 40s, will I pick up more shares? Will the risk reward calculation at that time be interesting? Probably. So that's my thoughts on PayPal. Let me know what you think. Are you a buyer, seller, holder, etc.? Comment down below. Also, thank you guys for subscribing. To all those that subscribed, I actually hit 1,000 subs. Yay! If you're new here, hit the sub button, like, subscribe, all of that good stuff. Thanks for watching. Let me know what you think down below. Bye.